I enjoyed that presentation from Steve because it reminded me of a joke we have among my colleagues of it's not about what we do on Monday morning, it's about how stressed we are on Sunday night, trying to think about what we should be reading and fearing for Monday morning. So I'm Steve Forbes, hardlines analyst and head of consumer research at Guggenheim Securities. I grew up in the world of consumer and retail, stocking shelves in my family's plumbing hardware supply store in Newark, New Jersey, and have been partial to the home as an investment profession for the past 15 years, viewing the category itself, right, huge category, as one of the few industries where product experience, service design, and personalization all come together, creating the business opportunity that many of you are chasing. My brother is actually an architect in Summit, New Jersey, and I often express to him how jealous I am of the tangibility of his model versus the intangibility of what we do. So I want to thank you all for being here. I admire a lot of your work. From Section 301 tariffs plus anti-dumping countervailing duties back in 2018 and 19, to the COVID-19 pandemic and all the related challenges, supply shocks, freight pressures, wage pressures between 20 and 22, and then obviously the Trump administration, tariff-centric administration, which has brought forth a second shock to the consumer on the supply side, has created a just tremendous amount of challenges for retail and consumer companies. So when asked by the team here at DLN to present on how tariffs will impact your business, I thought it would be best to sort of broaden out the conversation and really think about how it impacts strategic planning for models, how it impacts sort of where you sort of integrate different attributes of your business. A colleague of mine came up with this acronym about 10 years ago called VPED. And it was sort of to anchor businesses around thinking about sort of four key attributes that you need to consider, right? The first is having an unquestioned value proposition. The second is having sort of true product differentiation. The third is unique experiences, right, and value-added services, because we are a services economy. For all those, including myself, that thought goods would hold on to some sort of share of PCE that they captured during COVID, we were wrong. It's given it back extremely rapidly. And then lastly, just a credible digital offering. Don't ignore digital. You can't, right? It's gaining too much share. And if you think about the retail media platforms that all these businesses are investing behind, they are coming for everybody because goods growth, durable goods growth, is just not enough to support business growth. And so you have to find new attributes, new avenues of growth, and therefore you have to think about digital. As tariffs have business implications well beyond just acquisition cost headwinds. So I'm not sure if I know how to use this thing. There we go. As shown here, we've broken today's presentation into sort of 5 core sections. The first is sort of just an overview of how we speak about the consumer, the stressed and the blessed. Hopefully, many of you service the blessed. The second is competition is intensifying as the scaled, diversified growers rapidly take share and diversify their business into new attributes. The third is supply shocks and the challenge of rising input cost pressures. That includes tariffs, right? Tariff impacted inventory landed at the end of May. All the companies we cover and talk to, right, price increases are coming if they have not already hit. June, July is basically the timing of price elasticity test if those tests are not already being implemented. The fourth is sort of bringing the conversation back, trying to think about how do we find light, I think, to someone's question. Find light in what you do. You have to anchor the business, thinking about those 4 pillars of success. And then fifth is other long-term implications, right? As we're partial to the home, I think the home market is still something that is very unique and a huge business opportunity. And then if we have some time, also would love to take some questions. So first, stressed and the blessed. So sort of starting this off here, we want to talk about the maturation of the consumer sector, the services conundrum, right? Sort of what has evolved here with services versus good share, the e-commerce conundrum, importance of digital. Then we look higher level, right? As you sort of think about customer segmentation strategies. I think when you think about the next presenter, AI, and sort of all these sort of efforts that are going behind analyzing data, customer segmentation is really important. And the U.S. economy is sort of an interesting one because this stressed and the blessed dynamic really creates a subset of population that everyone's chasing. Everyone wants to service the top 20 million households, everybody, right? No one wants to service the bottom 20. And you have this great conundrum on sort of what's going on, and last is just household debt. So the first is, don't be fooled, right, by COVID. We are a mature economy. As you saw from the most recent data point in the first quarter of 2025, personal income has migrated back to a little over 4%. PCE usually sort of tracks 50 basis points below personal income growth as the wealthy save. And therefore, we have this sort of 3% to 4% secular growth in the world of the U.S. economy. And it's something to just sort of anchor around as you think about sort of what you should be sort of predicting or modeling for your own businesses as you sort of think about the bifurcation sort of between the segments. The second is this sort of head fake, right, on goods. So I cover mostly goods companies, durable goods companies at Guggenheim. We obviously follow the broader sector here, right? But there's a huge bright spot. I think even myself wrote during the beginning of COVID, the decade of the home. Sort of this optimistic around share capture, right? And where the consumer is going to allocate spending on goods, especially durable goods. That proved tremendously false. As you've seen over the past 2 years, services share has just gobbled up goods share and made it very, very difficult to sort of predict, sort of what's the outlook for durable goods. And you have sort of two things that are driving that, right? One, just the nature of us being a services economy. So historically, services spend will outstrip goods spend by about 200 basis points. And as you can see in this chart, right, we are settling right about there. And then second, right, is different sort of inflation deflation characteristics among the factors behind PCE. So this chart, I really like this chart, but this chart just shows you sort of consumables, goods, inflationary trends, discretionary pricing trends, and then services inflationary trends. And you can see how distorted things got during COVID, and how sort of consistent things were in the past. So discretionary goods are usually historically 2 points deflationary, consumables 1 to 2 points inflationary, services 4 points inflationary, and we were working our way back to that level. And now you're starting to see discretionary goods creep up, right? And we're likely going to sort of creep into that inflationary environment over the next couple of months here in discretionary goods. And that's going to be sort of a test on elasticity in sort of a very big way. And what does this sort of mean? A durable goods analyst, durable goods has basically become unpredictable. It's mind-numbingly frustrating. Many of us have sort of analyzed different wallet share capture statistics, thinking about real growth share of PCE. It has basically become impossible. And that's sort of what you're seeing in the business environment today of just tremendous unpredictability of where we go, especially, right, as you take a traditional deflationary category and make it inflationary. Because what we're not doing, right, over the next 2 months here when prices actually accrue to the consumer is we're not testing sort of historic price elasticity trends. We're changing entire value propositions across industries, right? And arguably that has only happened during supply shocks. And we've had 2 supply shocks over the past 5 years, one being the COVID supply shock and 2 being the Trump administration. I'll call it that, supply shock. The e-commerce conundrum here, right, and again, this is all sort of framework before we get into the other sections, is sort of this running joke, right? You have this bifurcation within end markets, the digitalization of categories. And historically, we used to see e-commerce growth within respective markets outstrip brick and mortar growth by about 1,000 basis points. You saw a dramatic shift, right, sort of COVID, but we're on our way back there. Right, and that sort of gets back to the fourth aspect of attribute of VPED, right? Digital offering, don't ignore it, because if we have sort of 1 to 2% growth in durable goods, and you think about sort of that spread between e-commerce or digital, or in essence how a consumer engages with you, you are talking about one subset of the market that's negative, one subset of the market that's positive. This slide here is one, again, for framework. It shows the evolution of household demographics, right, and just sort of 4 subgroups of income. And it might be a little hard to read, and we could share this presentation with whoever wants it. But what it shows here, right, is sort of how income, right, as you would expect, the share of overall income just continues to migrate up the household chain. And it shows how essentially 50% of Americans deficit spend, right? So you got 60 million households deficit spending. You got the government deficit spending, you got 60 million households deficit spending. And that sort of gets back to sort of customer segmentation strategies on what most companies on Wall Street are doing is really trying to target, right, the top 20, the top 40 million households, and then not stop with product, right? Product is not enough. Think about the integration of experiences, services. You're probably going to see more M&A activity over the next couple of years here as large models try to diversify their businesses in a pretty big way. So this bifurcation of wealth is dramatic to say the least. This just sort of amplifies wallet share characteristics. You probably have all heard this. This is sort of a visual representation of it. You take the bottom 50% of households, right, spending needs have outstripped income needs. In addition, right, you've seen food, housing, transportation, healthcare, all the consumable-oriented spending needs consume a dramatic amount of wallet share. And that's squeezed discretionary spending for that subgroup. But high-end's not immune. The same thing's happening, right? You're seeing the same bifurcation sort of with expenditure growth versus income growth, and then share of wallet, right? Again, continuing to get pushed into sort of the non-discretionary, consumable-oriented side of spending. And that has resulted, right, in the top 40, 50% of households controlling 80% of discretionary spend, which is a remarkable stat when you think about, again, targeting. And in essence, the way I sort of think about it is, especially, like my family runs a small business, right, is you have this encroachment factor, right? If there's not enough opportunity in lower income households or middle income households and everyone's chasing the same consumer, you're seeing it happen on Wall Street as well, right, with this bifurcation. And sort of the next section we'll get into is you see arguably the death of specialty retail get amplified in a big way because you can't just sell one category, you can't just sell a product. And then debt, right? Why rates are important. Everyone knows why rates are important, but this is sort of just a visual representation of household level debt characteristics. Mid to high single digit growth on a per household basis is certainly an elevated level of debt growth. That brings us to the second section. One more before we get to tariffs, is just this idea of competition. And I always like to say, you think about scale, right? As I think about what are tariffs really doing for businesses? Tariffs are making it more competitive for small businesses. Tariffs are benefiting scaled businesses. And so this section is sort of to show, arguably, as we refer to one of our questions we always ask investors or we talk to our companies, we always say, if you can't answer this question, you won't be successful, right? How do you compete with diversified growers of Amazon, Walmart, and Target? And they may not compete or sell into the product or service that you do today, but don't think they're not coming for you, right? So how do you compete with them? And that gets back to VPED, trying to bring it all back to business. So the first section here is just the overstored nature of the U.S. consumer, U.S. Market. Second is share capture rates, one of my favorite topics. Third is the CapEx advantage. Fourth is retail media advantage. So this slide is sort of been repurposed by us many years over the past decade. And the only thing that changes, right, is the company on the left that is closing stores. And remarkably, the number of square footage, right, or per household square footage really doesn't change. But I've always sort of liked this as a good visual representation of just how overstored the U.S. Market is, right? You got almost 90 to 100 square feet of retail space per household, which means when you think about traditional store sizes, 20 to 30,000 square feet, you almost have a store built for every 200 to 300 households. Just tremendously overstored, and that's why you see closures upon closures every year. You've actually had a significant number of closures already this year, right, with At Home and others. So just perpetual closures, but it doesn't always result in net retail square footage loss because there are growers, right, and there is repurposing of footage. And some of that footage is getting repurposed right into distribution footage. Some of that footage is getting repurposed into service-oriented or experience-oriented or hospitality-oriented footage. This is, it was sort of the first slide I thought of when I got asked to do this presentation of what do tariffs mean for business. And what I like to do here is just, you sort of focus on 10 years ago, right? So before we had the Section 301 tariffs, the anti-dumping tariffs, right, the countervailing duty tariffs, the COVID supply shock, et cetera, the big three of retail, Walmart, Costco, and Amazon, used to capture 50 cents of every dollar of growth within e-commerce and 25 cents of every dollar of growth within retail sales holistically. Massively dominant. What has tariffs done? It's increased those rates by 50 to 100%. So the big three now capture 75 cents of every dollar of growth in e-commerce and 50 cents of every dollar of growth within retail sales holistically, right? It's made them stronger, tremendously stronger. Input cost pressures, tariffs, supply shocks, freight challenges, wage pressure increases, it favors scale. It reminds me of when, I think it was a question about the stock market, when Besant sort of talked about the Dow will hit $50,000. My family owning a small business, our first reaction was, of course it will, right? Because it will come at the expense of small businesses, right? And to the benefit of public companies. Further evidence behind this share shift, if you look at retail sales and you parse it out a different way, there's still a flawed nature of the disclosure. It sort of bifurcates like non-store selling with traditional brick and mortar selling. Right, so Best Buy will be within electronics and appliances, right? But Amazon will be within non-store. And the whole point here, right, is if you just look at e-commerce share is migrating to the general merchants led by Walmart and Costco, right? E-commerce share is migrating to Amazon, right? The non-store operators, and e-commerce share in food and beverage is migrating to those large-scale food and beverage operators that now have retail media networks supporting their businesses. Every other aspect of brick and mortar retail is simply losing share. Another look at this, right, is if you were to add up the top 20 retailers, public retailers, well, the top 20 retailers, I think probably, maybe not public, maybe not in total, but public retailers. This looks at the evolution of their sales and then share of retail sales, share of PCE. The interesting fact here, right, is if you back out Amazon, Walmart, and Costco, the other 17 would have lost share of retail sales and PCE. What's driving that, right? You think about the CapEx advantage. So here it looks at CapEx spending for those same 20 retailers, adds it up, right? Sort of talks about the growth of Amazon, Walmart, and Costco as a percentage of total industry CapEx. Over the past 5 years, they went from 50 to 80% of total industry CapEx. And then retail media advantage, right? Somewhat new, I guess in terms of scope and breadth, even Costco, right, who's probably the slowest to change out there of a public company that has more means than anybody. Even they announced an intent to launch a retail media network last year. But now you got Amazon, Walmart, Costco, Target, eBay, Best Buy, Instacart, Kroger, you name it, with these retail media networks. And these retail media networks are just connecting consumers, right, with product and services. And they're doing it, right, direct to the vendors, right? They're providing the vendors with tremendous consumer data. And if you think about whether it's the integration of Gen AI or other capabilities, mapping households with the information that's out there today is not that difficult. And it's providing a tremendous advantage around share capture. So if we go back to that slide on where do I think share capture rates are going to go 5 years from now among the big three, the answer is up. That gets us to sort of the, I guess, the topic at hand. It's a pretty long prelude. But tariffs here, right, I sort of broke this section down into 5 parts. The fact that we've had 2 supply shocks, I mean, supply shocks usually don't occur, right? Demand shocks occur. Supply shocks are just dramatic and disastrous, right, for everybody. We've had 2 over the past 5 years. Don't kid yourself, right? Tariffs are input costs. Section 301 tariffs get reverse engineered into product cost. Product gets reverse engineered, right? Quality gets stripped out. Tariffs are an input cost pressure. These tariffs, whatever stays in place, will eventually get incorporated. Will it lead to inflation or deflation? My view of it first is it's inflationary first, deflationary second, right? Likely depends on sort of what occurs with the consumer real growth outlook in general. But if you destroy enough demand, you consolidate enough demand, and you give people enough time, right? You can reverse engineer, and it will come across as deflation over time. And that's why I think sort of the administration's view of it is if you actually take a 3 or 5 year view, you can actually argue that tariffs could be net deflationary, but it's inflationary first. Migration strategies, mitigation strategies, I'm sure you're all familiar with them. We just want to talk about it. And then value proposition impacts as you think about this sort of entering this period of time of just tremendous price elasticity uncertainty. It is upon us, right? June, July, that's the time. We're going to learn a lot over the next 2 months. So quick summary, right? The International Emergency and Economic Power Act, IEEPA, right? Goods from China, announced on February 1st, effective February 4th, initially 10, then 20%, right, for fentanyl. You then had a month later, right, the goods on Mexico, non-compliant, USMCA compliant goods, 25%, right, and then potash and energy, 10%. You then had the Section 232 duties on steel and aluminum on March 12th, which was originally 25%, now is raised to 50%. That was a big surprise for companies. Big surprise for companies. No one was expecting that. So it's just another draw on working capital to expect. And then you had the reciprocal tariffs. I'm very close with a lot of home furnishing companies, including Restoration Hardware. I don't think I'll ever forget that day of what transpired. But that was a blank moment. In general, as you think about just these tariff rates, and it caused. I don't know if any of you have seen this slide, but it caused just a tremendous shock, right, for all of us who are trying to analyze and predict and forecast sort of what's going to happen with businesses. This slide I actually really like because it was sort of a real-time look at sort of what the expectation of GDP was, right? And you think about the progression of tariffs. It was like, the initial tariff was a 20 basis point impact on GDP. And then it's like when the reciprocals hit, you're like, we're going to take a 3-point hit on GDP. That's what the market was freaking out about. And it was real. I mean, it reminded me of the midst of COVID, right? Because I think when COVID initially hit, it was a we'll all go down together mentality from a lot of companies. And I think when the reciprocal tariffs hit, it was a we'll all go down together mentality when you think about how bad it could have been. You look back to the Section 301 tariffs, in sort of the list here, sort of as I mentioned before, they weren't as impactful because you had some time last time to migrate, to mitigate. And I think it was sort of a first step or first look at the willingness of some of the vendors in these countries to just give a little bit. You also had a 10-point give from currency itself back then, right? So there's a lot of sort of inherent funding mechanisms behind the 301 tariffs, which is why if you use the 301 tariffs as a case study for the current tariff regime, you'll probably come to the assumption that it won't be that impactful. But my gut on that would probably be that you'll be incorrect. Migration strategies, right? So, back in 2018-19, right, it was just Pan-Asia, all the Chinese companies, right, got up, moved, built some long-dated capital in all these countries. That continues to be underway. I think it was mentioned before. You got a 10-to-1 labor benefit. You got environmental issues here in the United States. A lot of this stuff, you got raw materials that are sourced out there. This stuff's not coming back, at least in a lot of durable good land. And so migration, right, continues to be a big lever for people. We talked to a lot of vendors out there in Vietnam, and I think there's really no consensus on what's going to happen. And it's sort of this mentality of wait and see. So I think it was to someone's question before on July 9th or August 12th, right? It's sort of this wait and see mentality. Vendors are giving a lot now and likely going to take a lot later. From the conversations we have, any increase in tariffs will be a one-for-one price increase. So the vendors have already consumed their margin that they're willing to give. We talked about environmental issues, labor issues, and then just really, I don't know exactly your businesses, right? But the value of global supply chain capabilities and knowledge, right, and certainly expertise are of the utmost importance today. Mitigation strategies include vendor negotiations, obviously, substitution or value engineering. That was sort of the first message from those companies that were first to report post the reciprocal tariffs. You just basically cancel shipments, right? You look for a substitute product, value engineer product. Importer of record changes is a big one. For those scale operators who take the containers themselves and are the importer, you're just going to change the importer of record to the vendor themselves, and you therefore pay the tariff on the landed cost for the vendor, not the landed cost for the wholesaler, importer, or retailer. Pricing actions, right, which were currently underway, and it's like cost management practices. So Last time, if you think about 2018, 2019, the general thought, right, was a shared thought. One third, one third, one third. Probably even less than that because you got the first 10% was offset by currency, and then it was really 5, 5, 5. And therefore, you saw like low to mid single digit pricing across the industry in durable goods. Here, right, with the tariff, you're seeing mid single digit price increases take hold, mid to high single digit price increases take hold, with the view that if nothing changes, you're likely going to have 2 concurrent mid-single digit price increases on average, we would say, across the world of durable goods, and so an aggregate sort of double-digit price increase over the next 12 months. And the challenge, right, is intuitively, if you're a business and you're trying to manage your business, you ideally want to manage the gross margin rate. You then migrate to the gross profit dollar. You then migrate to EBIT rate and EBIT dollar. We are in the sort of learning phase of what categories you can manage to rate, and over the next 2 or 3 months, we will see what categories fall into which buckets of cost management practices. This is just a slide, again, from an investor point of view of just showing the advantages, right, of some of the big retailers. They are the largest importers, right, and so they have the ability to change the importer of record, and they also just have tremendous scale, right, over the suppliers. Value proposition impacts, right, like holistic value proposition knowledge is so important. Price elasticity demand will be tested, right? So know your value, I think, is like the biggest point I would make on that front, right? Like, and it's not value in the sense of having the lowest value, right? It's a holistic competitive value proposition. Know your customer data, right? So customer segmentation strategies, right? Like you have to know who you're selling to. Data analytics. Again, I think the next presenter on AI and just the importance of leveraging some, whether it's third-party talent, right, or resources at your disposal. And then the rising consumer expectation may increase the cost of servicing, selling. Sort of just think about how hard it is to please the consumer. Hopefully you guys deal with pleasant customers, but not everyone is pleasant. Certainly not all the time, including myself. The fourth section here is just the 4 pillars of success, and I'll run through this so we get maybe some time for questions. We hit on this, right? I think this is where I just want to bring it home, right? Because I often I think Wall Street can often be doom and gloom a little bit on just the challenges for small businesses. It's why I sort of mentioned my family runs one, or I guess 2. You really have to anchor around something, right? And I've always liked this sort of 4 pillars of success because it sort of cuts across all the different risk factors in business today, right? Value, product, experience, digital. Don't ignore any of them. Right, and then the question, right? How will you protect your business against diversified growers of Amazon, Walmart, and Target? Don't be fooled, right? Marketplace models expand the reach of scale omnichannel operators. Many of them, Home Depot included and others, right, are looking at other ways to grow their businesses. If we go back to the beginning of the presentation and think about durable goods growth outlook of 1 to 2%, right, that's not enough growth for big businesses. You have to find new avenues of growth, and so you're seeing operating models continue to consolidate distribution points. You're seeing marketplace models evolve. I think we probably have the most marketplace launches since COVID this year, right? You got Lowe's launching a marketplace. You got Ulta launching a marketplace. Everyone's exploring different sort of business models to grow their businesses. In-home selling versus in-store selling. You're seeing sort of this idea of migrating into the home, investment in in-home selling capabilities. Again, I would imagine a lot of your business, right, is done in the home. It's something that is going to be a natural extension of big models. Retail media advantages that are leveraging, and then just customer loyalty programs. Like I always Amazon, Walmart, and Costco have one. They sell to everybody. They have captive loyalty programs. They have retail media networks that are so big. You have to be able to, as a business, define how you compete with them, and also think that their business isn't static, because their business is not static. They're also looking for new growth opportunities. And then the last slides here is just why I love the home. The willingness to spend is high, desire to personalize is high, trade-up behavior, right? That integration of service, product experience, design, personalization, I think is why we, as an investment analyst on Wall Street, continue to be biased towards home-centric investments in the world of durable goods, versus the single category sellers, especially brand dominant sellers like sporting goods, right, or consumer electronics, or beauty and personal care. I think the home is a great category to participate in and a great category to service because of how important it is to consumer. And this just really quickly just shows you sort of 4 metrics we like to look at, right? Private residential fixed investment remains below average, so we're underspent on the home. Aging stock, right? You got almost 60% of households that are over almost 40 years old. Elevated levels of home equity, right? Significant amount, right? So that's the purple line there, almost $40 trillion of home equity value. And home price appreciation remains healthy. Obviously, there's some fears about home price appreciation, but I think in general, even if we were to have some markets, right, sort of see pressure, you certainly have a tremendous amount of untapped equity in the event that we get some help from rates. It's really going to be a watch out moment, right? So the home is a category that I think you really have a great opportunity ahead. I think a lot of it's just sort of appreciating the challenges at hand. And VPED, right, is your answer, I guess. So with that, I'm at time. I don't know if we have time for questions, or I could take them at lunch. Okay, 2 questions.
My question is, where do you see the value of the dollar? So the last 2-3 months, the value of the dollar has gotten weaker. Currency is an important kind of component in our margin. Nobody's really talked about that. I won't hold you to it, but where do you see the strength in the dollar?
I'm not sure I'm educated enough to give you an answer on that. I'm not sure I could actually give an honest answer. I think what you've seen happen here, right, is very predictable with the bond market and so forth. I'm not sure I would bet against the U.S. economy in that regard, but in terms of like foreign currency strength and exchanges, I'm not sure I can really give you an honest answer. Hedge, if you can. Any more?
All right, you answered everyone's questions.
Well,
So thank you so much for that, Steve.